Have you ever felt that something is about to snap, but nobody around you can hear it? What if the real warning sign isn't a headline, not a chart, not a crash, but a quiet, mechanical failure happening while everyone scrolls and laughs? Because that's the kind of moment we're in right now. And most people will only understand it after the door is already shut. I need to tell you something most people won't notice until it's too late. I'm an independent commodities analyst, and I've been tracking the physical silver market for 12 years. If you want the backstory behind this artificial intelligence avatar, it's on the channel's front page. But right now, none of that matters. What matters is that the global financial system for silver is literally hitting a brick wall. While the world watches football and doom scrolls, the plumbing behind silver pricing is choking. On Friday afternoon, the big financial outlets were talking about a Greenland real estate angle, dressing it up as geopolitics, diplomacy, bargaining power. That's the screen. That's not the engine. This is not about land, Arctic minerals, or whatever surface level take you'll read tomorrow morning. This is about a physical liquidity trap tightening around the London Bullion Market Association, and by extension, the entire global silver pricing mechanism. Here's what actually happened. Friday night, the government dropped what I call an economic warhead tariffs of 10% on imports from 8 European Union nations, plus the United Kingdom scheduled to start on the 1st of February. That's 14 days away. And here's the part that should make your skin crawl. That list includes the United Kingdom, the home base of the London Bullion Market Association, the most important silver trading hub on Earth outside New York. When futures reopen tomorrow night, the route for silver to cross the Atlantic won't just be expensive. It becomes economically unworkable for bullion banks to operate the way they always have. Let me be very precise here, because this is not speculation, it's math. That 10% tariff, with a built-in escalation to 25% if no Greenland deal is reached by the 1st of June, created what I call a one-way valve in the global silver market. Millions of ounces of physical silver are now effectively trapped inside United States borders, leaving London exposed with only what it already has on hand. If the LBMA cannot borrow metal from COMEX vaults in New York to cover its short positions, the global pricing mechanism doesn't bend, it breaks. This is not a squeeze that pushes silver from $90 to $110. This is a structural rupture in how silver is valued worldwide. A scenario where physical silver trades above $100 an ounce, not because investors are excited, but because the supply chain itself can't function. In this video, I'm breaking down 3 things. First, how this geographic arbitrage trap actually works and why it now matters more than any macro indicator on your screen. Second, we'll stress test the math and see what happens when 10% turns into 25. And third, I'll walk you through my personal battle plan for the next 14 days, because when the music stops, you don't want to still be looking for a chair. Before we go further, you need to understand one foundational truth. Gold is the money of kings. Central banks hoard it, governments stockpile it. It anchors the monetary system. Silver, on the other hand, is the system's Achilles heel. It's used everywhere, consumed constantly, and fractionally reserved to a dangerous degree. And that heel is about to take a direct hit. Let's look at the data everyone thinks they understand. Around 2:30 in the afternoon Eastern Time, silver was trading at $89.94. Gold was down about 1.6%, sitting just under $4,600. On the surface, that looks rational. Tariffs strengthen the dollar. Metals dip. Algorithms do what they're programmed to do. But that paper reaction completely ignores what's happening underneath. Here's what the paper market doesn't see. While prices were slipping on screens, the physical market was already whispering that something was wrong. Bid-ask spreads began to stretch, subtly at first. Not enough to trigger alerts or cable news banners, but enough that anyone watching physical dealers noticed. The gap between what buyers were willing to pay and what sellers demanded was widening. That's always the first crack, and it showed up quietly, late on Friday after London had already closed for the weekend. Then came the real problem. The tariff announcement landed when the LBMA was offline. London went to sleep thinking it was still playing by yesterday's rules. It has no idea yet that it woke up inside a trap. To understand why this gets even more insane, you need context. In the first quarter of 2025, tens of millions of ounces of physical silver left London vaults and moved into New York. This wasn't random. It was premeditated. Bullion banks knew a Section 232 review was coming. That review determines whether imports threaten national security, and silver as a strategic mineral used in solar panels, missiles, electronics, and defense systems was obviously on the list. So banks did what banks always do. They moved metal early. They repositioned silver from LBMA vaults into COMEX warehouses, believing they were getting ahead of future restrictions. And now, with a single weekend announcement, the exit door slammed shut. That silver is stuck in New York. The banks lost their pressure release valve. They can no longer move metal freely to cover shortages on the other side of the Atlantic. The illusion of abundance is breaking down, not because demand exploded overnight, but because the pipes that move supply just got kinked. This is where we need to talk about something most retail investors have never even heard of. Yet it drives institutional trading decisions every day. It's called a geographic arbitrage trap. And once you understand it, you'll see why this situation is so dangerous. Let me slow this down and make it crystal clear, because this is the heart of the entire problem. A geographic arbitrage trap happens when the cost of moving an asset between two major markets becomes higher than the price difference between them. When that happens, supply freezes. Let me give you a simple picture. Imagine two pockets. Your left pocket is London. It's empty, and a bill is due right now. Your right pocket is New York, stuffed with $100 bills. Normally, you just move cash from right to left and solve the problem. Now change one rule. Every time you move a $100 bill from New York to London, the government takes $25 on the way back. Technically, you're rich in one pocket, but functionally broke in the other. You can't fix the shortage without destroying a quarter of your capital. That's not inefficiency, that's paralysis. And that's exactly what's happening in silver right now. Under normal conditions, this never becomes visible. If silver trades at $90 in New York and $91 in London, arbitrageurs buy in New York, ship to London, sell, and pocket the difference. That constant flow is what keeps global prices aligned. But introduce a 10% tariff, and later 25%, and that flow dies. The metal can leave the United States, but it can't come back without massive losses. This creates two prices, a trapped American price and a starving London price. And once those two prices disconnect, the modern precious metals system enters territory it has never had to navigate. This isn't theory. This is the moment where spreadsheets turn into physical constraints, and where paper promises collide with real-world logistics. Now let's put numbers on it, because this is where people stop arguing and start sweating. At roughly $90 an ounce, a 10% tariff adds $9 to every ounce moving across borders. That alone sets a hard floor under domestic silver prices. London can't pull metal cheaply, and New York can't release it without knowing it's gone for good. The system locks itself in place. Now escalate that math to the nuclear scenario. If no agreement is reached by the 1st of June, the tariff jumps to 25%. At current prices, that's roughly $22.50 per ounce just to bring silver back into the United States. Read that again slowly. $22.50. That becomes the minimum premium required for arbitrage to function. Anything below that, and metal simply does not move. Logistics shut down, not emotionally, but mechanically. Here's why that terrifies bullion banks. The LBMA is rumored to be structurally short tens of millions of ounces. We don't get real-time disclosure, but inventory drawdowns in early 2025 strongly suggest exposure north of 50 million ounces. If London needs that metal, and the only available supply sites in New York, the premium required to extract it must exceed the tariff. That pushes the mathematical break-even price well above $100 per ounce. This is not a bullish fantasy. It's not an inflation trade. It's not a story about currency collapse. It's the minimum price required to restore physical flow under the new rules. Look at COMEX inventories and you'll see something strange. Registered silver, the metal actually available for delivery, isn't moving. Not because there's no demand, but because every ounce that leaves becomes dramatically more expensive to replace. The smart holders already understand this. They're not selling, they're not shipping, they're waiting for London to blink. And now I know what the skeptics are already typing. They always arrive on schedule. This is just a negotiating tactic. Silver will be exempt. Rules will change. Let me address that calmly. If strategic minerals were meant to be exempt, the announcement would have said so. It didn't. It said all goods. That wording is deliberate. Negotiating tactics only work if the other side believes you'll follow through. Announce a tariff, then immediately carve out exemptions, and you reveal the bluff. This administration doesn't bluff on tariffs. We've seen this playbook before. And the United Kingdom isn't protected by Brexit here. It was explicitly named. No collective bargaining shield, no escape hatch. London is more exposed now, not less. The next counter-argument is that the exchanges will just change the rules. Cash settlement, extended delivery windows, accounting tweaks. And yes, they've done that before. But here's what that crowd always misses. Changing rules doesn't create metal. If London has contracts that require physical delivery and the metal cannot reach them economically, no rule change in New York fixes that shortage. You cannot fulfill a physical obligation with a spreadsheet or a PDF file. Eventually, reality audits the paperwork. That's why the next 14 days matter so much. I'm watching several signals very closely. First, margin hikes. When volatility rises or a squeeze starts forming, exchanges raise margins to force leveraged players out. It's how paper sell-offs are engineered while physical supply tightens. A single-day margin increase north of 20% would be a clear sign they're retrying to suppress stress, not manage it. That tells you the pressure is already inside the system. Second, watch the media silence. When things get dangerous for banks, coverage doesn't increase, it vanishes. You'll hear vague language shifts. Inventory becomes liquidity. Allocated and unallocated silver suddenly get discussed as if they're interchangeable. That linguistic fog is always deployed when vaults are getting thin. It's not education. It's misdirection designed to buy time while obligations stack up behind the scenes. Third, and most important, the EFP spread. Exchange for physical is the bridge between futures contracts and real metal. Normally, that spread is a few cents. If it widens to $1, $2, $5 per ounce, it means paper and physical have officially divorced. That's the alarm bell. At that point, futures prices no longer represent reality. They represent whatever keeps the system functioning for one more day. And finally, every headline coming out of Greenland matters. Every stalled meeting, every diplomatic delay, every vague statement pushes us closer to the 10% tariff becoming real and eventually the 25% escalation. The market is still pricing in a neat resolution. I'm not. 14 days to solve a problem that's been hidden for decades. When time runs out, the one-way valve closes and the math takes over. Now I want to be absolutely clear about what I'm doing personally, because transparency matters when things get this tense. I am not your financial advisor. I'm not telling you what to buy or sell. I'm someone who has been accumulating physical silver for more than a decade, and I'm watching a slow-motion failure unfold. What follows is simply my own playbook, shaped by experience, not theory. You decide what makes sense for your situation. Trigger one is the $92 level. If futures reopen Sunday night and silver holds above 92, that tells me the market has begun pricing the arbitrage trap. That's more than a technical breakout. It signals institutional money waking up to a structural shift. If that happens, I do nothing. I hold my core physical positions without hesitation. I don't care if price runs to 100 or 120. The metal stays in the vault. Trigger 2 is COMEX inventory movement. I watch the daily warehouse reports closely, especially the shift between registered and eligible silver. Registered means available for delivery. Eligible means stored but not for sale. If large volumes migrate from registered to eligible, that tells you big players are pulling metal off the table. They're preparing for scarcity. That behavior always comes before the headlines. It's quiet, deliberate, and extremely bullish for physical holders. Trigger 3 is the fake breakdown. If silver drops to 85 this week on headlines claiming this is just a bluff, I don't panic. I prepare. That kind of dip would be a gift, not a warning. It would be the paper market forcing weak hands out before reality asserts itself. I'm not talking about leverage. I'm not talking about options or futures. I'm talking about physical metal I can actually hold. Trigger 4 is aggressive margin hikes. If margins jump more than 20% in a single move, I step away from paper entirely. That's the exchange telling you it's afraid of disorderly price action. Margin hikes are not neutral. They are weapons used to control behavior. When they're that sharp, it usually means the physical side is tighter than anyone wants to admit. At that point, I let the metal do the work. And trigger 5 is the nuclear signal, the London-New York spot spread. If that spread reaches 5% or more, we are in force majeure territory. That's the legal term for we can't deliver what we promised. It means arbitrage is dead, the valve is closed. From there, my plan is simple: hold physical, avoid paper. Wait, because once the illusion breaks, there is no fast rewind. Sunday night, the 18th of January, 2026. Silver sits just under $90. The screens look calm. Commentators talk about diplomacy, Greenland, and negotiation theater. But beneath that noise, a physical liquidity trap is tightening around the heart of the silver market. In 14 days, the cost to move silver across the Atlantic jumps by 10%. In a few months, it could reach 25%. Banks shifted millions of ounces into United States vaults to dodge import risk and instead sealed themselves inside an export cage. London is short, New York is locked, and the bridge between them is closing. This is not a prediction built on hope or fear. It's arithmetic applied to logistics. When metal cannot move, price must adjust. Not because anyone wants higher prices, but because physics demands it. Paper promises only function while delivery is believable. When that belief cracks, two prices emerge. One for contracts, another for metal you can actually touch. What happens next will not announce itself politely. One morning the price will gap, dealers will be empty, premiums will explode, and people will ask how this happened overnight. It didn't. The signal was sent quietly. The only question now is who listened, and who trusted the screen instead of the math.